So once again, welcome everyone in this fourth part of this ratio analysis series. So in this particular video, we are going to discuss about the expenses ratio. So let us start. So in the first part, we have discussed about the ratio analysis and the current ratio, quick ratio. All in the second part, we have discussed about the long-term ratios, and in the third part, we have discussed the turnover ratios. Okay. So in the fourth part, we are going to discuss about the expenses ratios. Okay. So the expenses ratio should be compared over a period of time with the industry average as well as with the ratio of the firm of similar type. A low expense ratio is favorable, and the implication of higher ratio is that only a small percentage share of sales is available for meeting financial liabilities like interest, tax, and dividend. So expense ratios are nothing but we are going to express the ratios. We are going to express our expenses in the ratio form, and a low ratio is always favorable because that shows that our expenses are low, while on the other hand, if the ratio is higher, that means that a small percentage of share of sales is available for meeting the interest, tax, and dividend. So if your expense ratios are higher, that means you are going to face some problems, that because if your expenses would be higher, then your net profit will be lower, so that you are going to face some problems regarding interest, tax, and while also paying the dividend, etc. So coming up, these ratios are calculated by dividing the various expenses by sales. So the variants of expenses ratios are, the first one is material consumed ratio. These ratios are very easy. You can easily memorize them. Material consumed ratio, so it is easy, just like material consumed divided by net sales into 100. The next one is manufacturing expense ratio. So manufacturing expenses divided by net sales into 100. The next one is administration expenses ratio. So administration expenses divided by net sales into 100. The next one is selling expenses ratio. So selling expenses divided by net sales into 100. The next one is operating ratio. This is an important one. So in the operating ratio, what we will do, we will just club the uh, our cost of goods sold plus our operating expenses. Okay, and then we will divide this with net sales. Okay, and into 100. So there is one more ratio, that is operating expense ratio. So OE ratio, operating expense ratio. In this particular ratio, what we use is, we'll just use the operating expenses part and divide it by net sales into 100 to get the operating expenses ratio. But for the operating ratio, just remember one thing, we will also include our cost of goods sold with the operating expenses to get the operating ratio, and then we will multiply it with 100. So the next one is financial expenses ratio. This is just like previous one, the financial expenses divided by net sales into 100. So it is these ratios are very easy to remember. Just go with their names, like material consumed ratio, so material consumed by net sales into 100. Manufacturing expenses ratio, so manufacturing expenses by net sales into 100. And in this similar way, just remember one thing, while in the case of operating ratio, not the operating expense ratio, but the operating ratio, what we will use, we will just club the operating expenses with our COGS, that is cost of goods sold, and then we will divide it with net sales and multiply it with 100. So in all the cases, the denominator is net sales, net sales, net sales, net sales, and net sales. Okay, so you will just divide those particular expenses with our net sales into 100 to get our expenses ratio. I hope this is clear. Coming up, so let us discuss some other ratios like return on asset. This is a very famous term in finance and accounting all. So ROA, return on asset. So this ratio measures the profitability of the total funds of a firm. It measures the relationship between net profit and total asset. The objective is to find out how efficiently the total asset have been used by the management. That means it simply deals with how efficiently the management is dealing with the its total asset to generate the profit. So how efficiently they are using their asset for getting higher profits, or for generating more revenues for the company or firm. Okay, so the formula is return on asset is equals to net profit after tax plus interest divided by total asset into 100. Just remember one thing, net profit after tax, but we will include our interest. Okay, yeah, plus interest, and then we will divide it with total asset into 100. So net profit after tax, NAT, plus interest divided by total asset into 100, and the total asset excludes the fictitious asset. That means in the total asset we must have to deduct our fictitious asset, that are preliminary expenses, discount on issue of share, those things. FA, fictitious assets, need to be excluded from our total asset. Okay, as the total asset at the beginning of the year and the end of the year may not be same, so average total asset may be used as the denominator. So in the case, while we have the two balance sheets at a initial period and at a closing period, so what we will use, we will simply add the opening and the closing, and then we will divide it with 2 to get our average total asset. Okay, and then just remind one thing, we have to deduct our fictitious asset while calculating the total asset. Okay, so net profit after tax plus interest divided by total asset minus fictitious asset into 100. Okay, so this is ROA, return on asset. Coming up, return on capital employed, ROC. This one is also important, and this ratio measures the relationship between net profit and capital employed. The previous one was the relationship between net profit and your total asset, and this measures the relationship between net profit and capital employed. Okay, it indicates how efficiently the long-term funds of the owners and the creditors are being used. Okay, that means the long-term funds owner, that are the equity share capital, preferential capital, debt, and your debentures, your bonds, your long-term capital, along with your creditors, are used in the firm. So return on capital employed is equals to net profit after tax plus interest, just like the previous one, NAT plus interest, and we will now divide it with capital employed. In the previous case, we are using the total asset, and we are of course excluding the fictitious asset, and this time we are going to use the capital employed into 100. So net profit after tax, then we will add interest, and then we will divide it with capital employed into 100. So let us understand what is capital employed. So capital employed denotes the shareholders fund plus long-term borrowings. To have a fair representation of capital employed, average capital employed may be used as the denominator. So in the at the initial period and at the closing period, we will just club it and divide it with 2 to get our average capital employed. I hope it is clear. Coming up, the next one is return on shareholders equity. So this one is also one of the important ratios. So this ratio measures the relationship of profit to the owner's fund. The first one is return on asset, that is ROA, that is dealing with the total asset. The second one was return on capital employed, that is dealing with capital employed, and this one is related with our owner's fund. Okay, that is shareholders fund. So this ratio measures the relationship of profit to the owner's fund, and shareholders fall into two groups. The first one is, of course, we know preference shareholders, and the second one is equity shareholders. So the variance of the return on the shareholders equity are, the first one is return on total shareholders fund, that is net profit after tax divided by total shareholders equity, that includes the equity shareholder plus preference shareholder into 100. Now you must have a question in mind that in the previous two cases we are including the interest, but in this particular case, why we are not using including the interest? Because as you know, we paid our interest before paying to our equity shareholder or the preference shareholder, because it is a part of our indirect expenses. Then after paying the tax, it comes up to the total amount available for the shareholders. That is why we are not going to use our, that is why we are not including our interest here. So simply what we will use, net profit after tax, and then we will divide it with total shareholders equity and into 100. Okay, so total shareholders equity is include the preference share capital plus equity share capital, and remember one thing, the reserve and surplus, because it is also part of equity shareholders fund, as we have earlier discussed in the section of proprietary ratio. You can watch it in the second part of this ratio analysis series. While discussing the proprietary ratio, we have discussed it very clear, and then we will deduct the accumulated losses and the fictitious asset. This is also a key point, that we need to include three things, that is equity share capital, preference share capital, and RNS, that is reserve and surplus. And we need to deduct two things, that is accumulated losses and our fictitious asset, to get our total shareholders equity fund. Okay, and to have a fair representation of the total shareholders fund, average total shareholders fund may be used as a denominator. I hope it is clear. So coming up, and there is the another part of this, of course, it only deals with the ordinary shareholders equity, that is, it only deals with the equity shareholders. So return on ordinary shareholders equity, that equals to net profit after tax, and we will just deduct the preference dividends part. So just like the previous one, we will just use the net profit after tax, and we have to deduct the preference dividend, as because we are using only for the ordinary or the equity shareholders. Okay, so we will deduct the preference dividends amount, and then in the denominator we will use equity shareholders fund. Now remember one thing, that in this case we are going to include our RNS, because reserve and surplus is a part of equity shareholder, not for the preference shareholders. I hope it is clear. So the ordinary share equity or the net worth includes the equity shareholders plus capital and reserve or surplus, and then we are going to deduct the fictitious asset. As you know, as the reserve and surplus are the part of equity shareholders fund, as always, so the fictitious asset are going to deduct from the equity shareholders, not from the preference shareholders. Okay, I hope it is clear. So this is just like, so return on shareholders fund is net profit after tax divided by total shareholders fund. While in the case of return on ordinary or equity shareholders fund, is equals to net profit after tax minus preference dividend, and then we will divide the equity shareholders fund. And that particular equity shareholders fund, in this we are going to use equity share capital plus reserve and surplus. Then we have to deduct our fictitious asset. Okay, coming up. So the next one is EPS. It is one of the most famous terms that we see, earning per share. So this ratio measures the profit available to the equity shareholders on a per share basis. Okay. This ratio is calculated by dividing net profit available to the equity shareholders by the number of equity shares. So EPS is equals to net profit after tax minus the preference dividend. Okay, and it is simply, we will divide it with the number of equity shares. That means, let's say a company has a net profit of rupees 1 lakh, then it has a preference shareholders of rupees 10% preference shareholders of rupees 1 lakh. Then the preference dividend would be 1 lakh into 10%, that comes up to 10,000. So profit was after tax, net profit after tax was 1 lakh, and the preference dividend is 10,000. So 1 lakh minus 10,000, that comes up to 9,000. So if our number of equity shareholders are 9,000, then our EPS would be 90,000 divided by 9,000, that comes up to rupees 10. So each share's value is rupees 10. It is a very good, very important ratio, that is EPS, earning per share. So that shows what is the what is the value of our equity shares. Okay, so simply we will use the net profit after tax, and then we will deduct the preference dividend, and then we will just divide it with the number of equity shares. Okay, coming up, DPS, it is also important for ratio, that is dividend per share. That means how much dividend a shareholder, that is equity shareholder, is going to get. So this ratio shows the dividend paid to the shareholders on a per share basis. Okay, and this is a better indicator than EPS, as it shows the amount of dividend received by the ordinary shareholders. In the previous case, it was just showing the amount of earning available to earning per share, that how much the earning is going to get by the equity shareholders. But the DPS, that is dividend per share, it shows the how much the dividend that the equity shareholders are going to get. So This is a better indicator than EPS as it shows the amount of dividend received by the ordinary shareholders, while EPS merely shows the theoretically how much belongs to the ordinary shareholders. So EPS just shows how much earning the equity shareholders are going to get, while the dividend shows the actual amount of dividend that they are going to get. So dividend per share is equals to dividend paid to the equity ordinary or equity shareholders divided by number of equity share. That means if the company has announced that they are going to give 1 lakh rupees of dividend in this particular financial year, and there are 10,000 equity shareholders in the company, then 1 lakh divided by 10,000, that comes up to rupees 10. That means they are going to get 10 rupees dividend in this particular financial year. This is, I hope this is clear for you. Coming up, dividend payout ratio. This one is also one of the important. So this ratio measures the relationship between earning belonging to the ordinary shareholders and dividend paid to them. That means dividend payout ratio is equals to total dividend paid to the ordinary shareholders divided by net profit after tax minus preference dividend and into 100. So, or we can simply use DPS by EPS into 100. That means it shows that, let's say the company has the earning available 10 rupees. That means if the company is going to give 6 rupees of dividend and 4 rupees they are going to retain it. So it shows that the ratio is 6 is to 4. So how much the company is paying as a dividend, that is dividend payout ratio. So for this it is easy, it is better if you using this formula DPS by EPS into 100. Otherwise we can also use total dividend paid to the ordinary shareholders, and then we will divide this with net profit after tax. Just we will deduct the preference dividend from it, and we will multiply it with 100 to get our dividend payout ratio. I hope it is clear. Coming up, price earning ratio, that is PE ratio. This ratio is computed by dividing the market price of the shares by market price of the shares and by earning per share, that is EPS. That means it measures the expectation of the investor and the market appraisal of the performance of the firm. That means price earning ratio, that is PE ratio, is equals to market price per share divided by earning per share. That means our investor, when he is investing in the particular company or a particular firm, that how much he is expecting, or what is the current market price of that particular firm. So market price per share of that particular company and that earning per share. That means let's say if the market price is 11, okay, and the earning per share is 10, then it is good. It comes up to 1.1 is to 1. And if it is if the market price is lower than the earning per share, then it is bad for the particular investor. Okay, so this ratio simply compares between the market price of the share with the earning per share. Okay, that is price earning ratio. Okay, so this is all for this particular video. I tried to cover all those formulas and the theoretical part of this ratio analysis series. If anything left out, then I'll try to cover it in a separate video. And in the upcoming video, we are going to discuss the numeric part of this ratio analysis series. Yes, it is very difficult to discuss all those lengthy numerics, but I'll try to cover some of the important and small numerics to get a brief idea about how to solve them. And thank you for watching. Thank you so much. Bye bye.